Hey everybody, John Gibson, Flagstar, Vice President of TPO, and I'm really excited about our next guest. Obviously there's a lot been going on in the marketplace right now, and I think he'll bring a lot of insights and viewpoints to that we can get into here in the next couple minutes. And with that being said, I'll let him introduce himself.
Hello everyone, Jason Lee, Executive Vice President of Capital Markets for Flagstar Bank. Just passed my 3-year anniversary as of April 1st with Flagstar. Been in the business for about 25 years and have actually known John for quite a while and worked together in the past.
We have known each other for quite some time now, which is a good thing. Really excited to have you here. Obviously, if you're in this industry and you happen to subscribe to anything, whether it be Housing Wire, start rattling off all the Barry Habib, all the different trades.
Right.
I think it's unprecedented times in my career. I started in '94, and I've never seen a market like this accelerate at the pace that it's been accelerating. So I guess the first question to kind of dive into is, in your tenure, I know you said you've been with Flagstar for going on 3 years. How long have you been doing it?
25 years.
So kind of give me your viewpoint in the current market conditions and what we're seeing.
Yeah, I mean, I thought I had saw everything, right? So never doubt this business, right? So every day is a challenge. Yeah, so I think we're seeing the culmination of a lot of things happening at once, right? I mean, I don't know if you want to call it a black swan event or what the name would be, but with a pandemic, we have a war going on. We have inflation that was allegedly transitory, but now it's not. Now we all agree it's not, right?
Yeah.
We have a Fed that's telling us they're going to raise rates multiple times throughout the year. So, you have about as best of a crystal ball for rates going up that you've ever had, really.
Ever.
Right?
Line of sight to what they're going to do, ever.
There's just a lot of uncertainty in the market, and liquidity dried up really quick. And we saw rates rise in March, 150 basis points on a 30-year fixed, right?
Yeah.
So, never happened in my career. I've never seen it. If you go back and look at the last 100 years, it's happened about 4 times, 80s, 70s, twice in the 80s.
Right.
So, we're writing another chapter in the history books, right? Refinances are gone. It's a purchase market. So for mortgage lenders, what we're seeing is you've kind of got multiple things happening all at once that usually happen kind of individually, right? Margins are compressing at a rapid rate, right? So we've built capacity to $4 trillion. Everybody's like, oh my God, what are we doing? We've got to figure this out, right? We're going to a 2.7. We're reverting back to the norm faster than we've ever reverted back. Of course, we have a long way to come down from the high of $4 trillion. Right?
Of course.
You've got profitability in question now, margins compressing. You've got companies that are pricing themselves on certain products. You might have had a lock with one guy Tuesday. By Thursday, he says, I'm not in this product anymore. It's really kind of getting back to, the old way of doing business. The partners you trust. Watching your pipelines, if you hedge, you got to be watching that throughout the day, all day long. We're seeing all kinds of things happen in the market from a mortgage-backed security standpoint, right? So the rolls, so when we price a rate sheet for a 30-day lock or a 60-day lock, there's a roll in there based on that mortgage-backed security, right? So typically that roll is about 12.5 basis points. As of this morning or recently, we're talking almost a half a point. Right. So it gets pretty dangerous when you're trying to hedge a pipeline or you're trying to lock a borrower in and hedge that, and all of a sudden the value of what you thought that loan was going to be in 60 days just lost a half a point.
Sure.
You can't hedge for that.
Right. You can't factor that in. Right.
I think some guys that were maybe on the smaller side grew the last couple of years, started hedging. Maybe now's the time to say, hey, do I really want to hedge right now? Or do I want to go back to, let me focus on my business, let me lock best efforts, let me just go back to being a correspondent, and I'm not going to monkey around with the markets, not worry about that.
Yeah.
I'm going to trust my partner, a large bank to take care of that for me. And I know in 60 days when I go to deliver that loan, they're going to be there.
It's interesting because I'll dive into that a little bit further, right? Because I do think that's one of the things you're talking about, the marketplace and the rapid change. And you do have, let's face it, we're coming out of historic low rates for the last 18 plus months, going over 2 years.
We haven't been over 5% in 10 years.
In 10 years, right? As I was going to say, if you think about it, when the calendar turned into 2022, we were still at 3% note rates, and now we're at a 5. I mean, we just put over a 6% interest rate on a rate sheet the other day.
Yeah.
We have, I know. So it's interesting you said that, because I do think that's one of the things I wanted to get from you, which there are clients that benefited from, business partners that benefited from that over the last 2 years, the environment they were in, but maybe weren't educated enough to exist in that same form or fashion going forward. So one of the things you talk about is, hey, is it the right time to assess my business, and does it make sense to go more best efforts? Anything else from that perspective you would look at, like maybe using more of a hedging company versus maybe employing people and doing it on your own, or anything like that?
I don't know. I mean, that one's a good debate.
Yeah.
Some hedging third-party companies are better than others.
Right.
They all kind of roughly do the same things. Just how well do they protect your pipeline and your P&L, right?
Sure.
They're kind of, depending on what you want to spend too, I think they're kind of all over the price range. But yeah, for us, I think, we can hedge the loans. We have a big pipeline. We've got a team of traders, a team in capital markets. That's all they do all day is watch the market. They're hedging our P&L, they're hedging our risk. And, like I said, if I own my own shop,
Right.
I would be reassessing right now and say, you know what, I'm going to pump the brakes on that piece of it. I don't want to take chances anymore. I'm going to lock my P&L in. I know what that's going to be 60, 90 days down the road.
Right.
And I'm working with my partners. I think there's probably, now that we're in this purchase market, right, it's new products or back to the future from, prior products that we kind of let sit on the back burner because there was just so much business and nobody wanted to talk about QM or non-QM, non-agency things. So I think there's different ways to look at how to penetrate that purchase business and market, right? And that's going to be products.
Yeah, for sure. I think that's product expansion as you're talking to. What else have you seen from a market perspective that's been kind of eye-opening to you over 25 years of doing this?
Another factor of this is we're seeing MSR values hit all-time highs, right? The value of that servicing at a 3 coupon, 3.5 or lower has just gone through the roof.
Yeah.
And so that's a little bit of the silver lining for some of the smaller shops that are seeing their origination drop off the cliff. The value of their servicing book is just skyrocketed. And how do I capture that value? Do I sell some of it now to get the cash to run the business? Do I hang on to it and ride it up from a GAAP point of view, from an accounting point of view? So we're definitely seeing a lot of small packages out there. When I say small, 500 million, billion, 2 billion servicing packages, Fannie Freddie, Ginnie Mae. And it's a good indicator, almost like a canary in a coal mine, that there's some smaller shops that they need to generate cash.
That's right.
And that's a quick way to get those out there and sell them and get them off the books and get that cash to run the day to day. Seeing quite a bit of that happen. If you read all the different industry rags that you mentioned earlier, right? The MSR brokers are saying, this is the busiest time they've ever seen in their career.
That's right.
And so we see it too. We see the packages come through. Not to mention, there's big ones too, right? You see them 10, 20 plus billion, larger chunks, which are usually your top 10 or top 20 guys, and that's just more of a horse trading, more so than cash flow.
Sure.
They might be kind of repositioning their book or rebalancing it for whatever reason that fits their strategy.
Yep.
But the smaller pieces, the smaller blocks, that's a pretty good indication that this is all starting to happen, right? The capacity's going down. There's some M&A activity happening out there. There's some guys that are just like, you know what? I had the best 2 years of my life in 30 years. I'm out.
Right.
So
it's a good swan song out the door, so to speak. Right.
Their MSR values are a big chunk of their worth and their company's worth. So that's what we're seeing happen there.